Someone on Reddit reckoned they'd retire off dividends with 500 grand. Another bloke said, you need at least 1.3 million just to be comfortable. So, which one is it? 500k or 1.3 mil? Here's the twist. They're both right. And by the end of this video, you'll know exactly which number applies to you, because it's not about how much money you have. It's about three numbers most people never even check. If you've ever typed, how much do I need to retire on dividends, into Google and gotten 10 different answers, stick around. We're sorting this out properly, the Aussie way. Real franking credits, real tax brackets, real numbers. Right, so why is there such a massive gap between 500,000 and 1.3 million? It comes down to three things. How much income you actually want. Someone happy on 40 grand a year needs a lot less than someone wanting 90 grand a year. What you're invested in, a high yield portfolio of bank shares and REITs, pays a very different income to a low yield portfolio of growth stocks, franking credits, and this is the bit almost nobody factors in properly, including some finance YouTubers who really should know better. So forget the clickbait number, let's build your actual number, step by step. Let's start with yield, because this is where most people get it wrong straight out of the gate. The ASX 200 average dividend yield sits roughly in the 4 to 4.5% range. High yield blue chips, think the big four banks, Telstra, some of the REITs, can push 5 to 6%. Growth-focused portfolios, think tech and international shares, might only yield 1 to 2%. Here's the twist most calculators miss. That yield percentage means almost nothing without knowing your franking level. A 6% yield from a fully franked Australian bank share is worth more in your pocket than a 6% yield from an unfranked international ETF. Why? Franking credits. When an Aussie company pays you a fully franked dividend, it comes with a tax credit attached because the company's already paid 30% company tax on that profit. If your marginal tax rate is lower than 30%, which it is for most retirees with modest income, you get that excess credit back as a refund. This is genuinely one of the best kept secrets in Australian investing, and it's the reason your real number might be lower than you think. Let's run the actual maths. We'll use a fully franked yield of around 5% as our base case, which is realistic for a solid blue chip Australian dividend portfolio. A $500,000 portfolio. At 5% fully franked, that's $25,000 in cash dividends a year. Now add the franking credits. At a 30% company tax rate, that grossed up income is actually worth about $35,700 before tax. If you're below the tax-free threshold or close to it, you could be looking at getting most of those franking credits refunded to you. For a single retiree with no other income, that's a genuinely livable amount in a low cost of living area, especially paired with the age pension if you qualify. The twist here, 500k isn't a you can't retire number once to do. It's a you need a frugal, paid off house, maybe part pension lifestyle number. Totally doable, just not flashy. Scenario B, $850,000 portfolio. This is the number a lot of financial planners quietly use as a comfortable single benchmark. At 5% fully franked, that's $42,500 in cash dividends, grossing up to roughly $60,700 with franking credits included. This is where things start feeling genuinely comfortable, covering a mortgage-free lifestyle, some travel, no real financial stress without needing to touch the age pension at all. Scenario C, $1.3 million. Portfolio. Now we're at the number from the title. 5% fully franked gives you $65,000 cash, grossing up to about $92,800 with full franking credits. This is firmly comfortable couple. Territory. According to the Association of Superannuation Funds of Australia's retirement standard, which pegs a comfortable couple's lifestyle at around $73,000 a year. With $1.3 million in fully franked dividends, you're well past that. with room for overseas trips and a newer car every few years. Here's where I have to pump the brakes a little because there's a trap in everything I just said. Chasing yield is dangerous. A lot of people see a stock paying 8 or 9% and think jackpot. Often, that sky-high yield is the market's way of telling you the share price has crashed because the company's in trouble and that dividend is about to get cut. We saw this exact pattern with several ASX companies during the mining downturn and again during COVID. Yields looked amazing right before the dividend got slashed to zero. The other twist? Concentration risk. If your whole portfolio is sitting in the big 4 banks because their yields look great, you're not diversified. You're making a massive bet on one sector of the Australian economy. When the banks got hit during the Royal Commission, a lot of dividend investors found out the hard way what concentration risk actually feels like. So the real number isn't just about the dollar figure. It's about building a portfolio that can actually sustain that yield through a downturn across banks, EITs, healthcare, utilities, and some international exposure for balance. So, how do you actually work out your number? 3 steps. Work out your annual spending need. Be honest, not aspirational. Track it for a month if you have to. Divide by your realistic franked yield. Use 4 to 5% as a sustainable, sensible range, not 8 or 9. Add a buffer of 15 to 20% for dividend cuts, market downturns, or unexpected costs because dividends are not guaranteed income no matter what anyone tells you. So if you need $60,000 a year at a 5% sustainable yield, that's $1.2 million. And with your 20% buffer, you're realistically targeting 1.4 to 1.5 million. That's the maths nobody puts in the thumbnail because it depends on your spending and risk tolerance. Doesn't get clicks. But it's the truth. So 500K, 850K, or 1.3 million? All 3 are right depending on the life you want to fund. The real question isn't what's the number, it's what's my number. And now you've got the formula to work it out yourself. If this helped clear things up, smash that subscribe button because next week we're breaking down the 5 ASX dividend stocks that have never cut their dividend in 20 years and whether they're still worth buying today. Catch you in the next one.